research, and we wanted to, we do this research every month, and we want to make sure that we only present to our buyers where we think the buy is the right time to buy, I should say. And it's important that we take advantage of the opportunities when we can in the property market. So Brisbane, for example, we were selling quite a lot in Brisbane 2 years ago, even 18 months ago. And right now we have almost completely stopped, unless a buyer comes to us and says we want a property in Brisbane. We've almost completely stopped because we think the prices are at a premium now in Brisbane. And the people we sold to 18 months ago are all very happy because they made at least 200,000 profit on most of the sales that we did. So this is what we do as a company. We make sure that we research everywhere and see where there is the best value pick. Now, in the last few days and weeks, there's a lot of media out there, and I'm sure you all see the news, and there is some positives, there's negatives. Last 6 months, obviously, there's been more negatives than positives. So on the left here is what I would say is the negatives to the property market. On the right side are some of the positives to the property market, okay, in terms of price growth. So we all know that the RBA's official rate, they've been tightening from 0.1% all the way now up to 2.85, and the RBA governor has said there's more to come. US Fed are being more bullish in the way they have done 75 basis points, and they've done 100 basis points as well. So that's ticked up very, very quickly to that range there. Now, the next number is extremely important because a lot of the drivers for this has been inflation, as we know. We've heard more about inflation this year than some of you might have heard in your lifetime, right? So the big number that came out in the US about a week ago is this number of 7.7% year on year to October. That was down from 8.2% in September. And it's the lowest rate in the US since January 22, okay? Our inflation, on the other hand, and their inflation comes out monthly, our inflation, on the other hand, which comes out quarterly, came out at 7.3, which was up 0.6.1 in the June quarter. So September quarter ticked up quite a bit. Expected, obviously, because we are lagging a little bit compared to the Northern Hemisphere countries in the rise in our inflation. But this fall from 8.2 to 7.7 was seen to be extremely significant in the US because it really moves the needle when it comes to the correction now that we're seeing in the inflation. And as a result, you might have seen in the last week, particularly in last week, Thursday and Friday, the stock market in the US actually picked up significantly. And the fixed rates, what they call the bond rates and the 10-year bond rates and treasury notes in the US, they came off significantly, okay? So these are very important numbers to keep an eye on. The next one there, and I won't go through all of these, but the next one there is the recessionary fears. We all worry about what's happening in the Northern Hemisphere countries, and particularly our major trading partners who are China, US, obviously, UK, Japan. They are all countries that are having significant slowdown in their economies, okay? And we need to be conscious of that, because if there is a recession, if there's a hard landing in any of these countries, and China is already feeling that because their last quarter growth was only 0.4%, that can have a bigger impact on our economy than the increases in rates here. So we have to watch this extremely closely. On the right, main things here is the top one is New South Wales related, and we've got a replacement now for stamp duty for thresholds up to 1.5 million in property purchases. Then we've got a major rental crisis. We'll talk more about that. Unemployment is in a very good place in our country at the moment, and in our state. We're steady at 3.5. We expect this to tick up a bit. Migration numbers, you've heard a lot of literature on that recently. That's going up. Going up means more and more people coming here, which is going to cause significant pressure on the rental crisis we already are experiencing. And we'll see more of that in a minute. And then our GDP, our gross domestic product, which is how fast our economy is growing, is very, very healthy. Okay, so this should be June. Yeah, that's the June quarter, and that's the March quarter. We haven't seen the September quarter number yet. Okay. So I said I do make predictions. These are some of my past predictions. So I did predict that property prices will increase by 20% in middle of 2021, when everybody else was actually saying that property prices will fall between 20 and 30%. I did write an article in the paper in July 2020, I should say, and happy to share that article with any of my listeners today, and the reasons why I thought property prices are going to actually go up by 20 against a market which was saying minus 20, minus 30. I did predict in June, July last year that interest rates will start rising in July 2022. Of course, it started a little bit before that. And I told my listeners never to believe the RBA governor, because rates are going to go up. It can't stay at 0.1% for very long. That was always going to be temporary. So a bit careless and irresponsible of the governor to give people the expectation that might not go up until 2024. I have asked all the clients that and all the listeners to actually fix their interest rates out to 4 to 5 years back then. Okay, so those that did are thanking me, and it's important actually to know what the real thing is versus what you hear in the news. So you'll hear that from me a few times today. I predicted in the third quarter last year that there's going to be a major rental crisis in 2022, with vacancy rates heading down below 1%. Well, we are now about 1.1, 1.2% in Sydney. Nationally, we are 0.9%, which is the lowest it's been for a very, very long time. Okay. In the next 6 months, you will expect chronic rentals in our city, as well as all across Australia. And then, of course, most people predicted this, so I'm not going to take much credit for that. But what my next prediction is that you will probably, with interest rate, you will probably see one more increase of 25 basis points. And I think that would more than likely happen in December. And then January, I don't think there is a Reserve Bank meeting in January. January and February, I expect there to be a pause. Okay, so January will be a pause anyway, and then February will be a pause. And the reason why I say that is we have had pretty sharp interest rate increases. And I think the next thing the Reserve Bank board would want to see is what is the impact of all of these increases on our market. Secondly, that's number one. Number two, there is strong evidence that inflation is reversing. Okay, and it will more than likely, in my personal view, reverse a lot faster than what the economists are actually predicting, okay, and the RBA is predicting. I think by second quarter next year, you will find inflation will be well under control. And then not only will interest rates have peaked at that time, but we'll talk more about interest rates in a minute, but you will find that there is a potential for interest rates to be reduced in the second half of next year. Okay, so what makes the needle move when it comes to property prices? These are my top 7 factors that actually moves the needle when it comes to property prices. So the very first one there is the most important. This is in some sort of order, okay? So supply and demand, just like any commodity out there, is the most important thing. Whether you're talking about cars, and you all saw car prices go up significantly during COVID because there was no supply. So same applies to every commodity, and property is no different. So when supply is high and demand is low, of course, prices are going to go down, and vice versa. Okay. So we saw in 2021, the supply of properties was low. Everybody wanted to buy a property. Everyone could afford a house because the interest rate went down so much, sub 2%, 1.99. You could do a fixed rate for 2 or 3 years. So at that time, everybody could afford $1 million in loans, and the demand went through the roof. The supply did not cope. And that's why we had a 25% increase in Sydney and across Australia too, for most cities. Now that phenomenon is gone. It was a short-term phenomenon, okay? I will say to most of you that a 25% increase in a year doesn't happen very often in Sydney or any city in Australia. So it was a one-off. It was the third time it happened in 100 years, a 25% increase. Interest rates and affordability is very, very important. Okay, these two are actually linked to, so that has linked to the demand. Demand went up because interest rates went down. What causes this is inflation and wages growth. So there was no talk about, in 2021, there was no talk about inflation and wages growth. There was no talk about it at all. This slide has been there for the last probably 4 years, okay? So these factors are what we are talking about more and more now. The third one there is a regulator, APRA. And APRA can, pull a few levers and dictate what happens with the bank's lending policies. And therefore that can in turn dictate what appetite banks have in terms of their lending policy. The key thing here in the lending policy, one of the things that APRA regulated, which was really, really important, particularly with hindsight, is they got banks to use a 3% buffer when lending, okay? When you're assessing your ability to pay a loan, they're using a 3% buffer. So if the variable rate was, let's say, 3%, it's no longer the case, but was 3%, then APRA would say, banks would say, I will assess you if you can pay at 6% interest rate, 3% buffer on the actual variable rate, okay? Not fixed rate, the variable rate. So you find that if they don't have a buffer when rates go down particularly, then you're gonna have a lot of people, when rates go up, they can't pay their loans. And that's number 6 here. When they can't pay their loans, if you can't pay your loan for 1 month, you'll be getting a lot of letters. 2 months, you'll get a lot more letters. 3 months, you haven't paid your loan, the bank will be knocking on your door and they will want to take over your loan and do what's called a mortgagee in possession sale of your house, okay? And they will take over your property, auction it, and then whatever is left, they'll take their loan and the accrued interest and the cost, and they'll give you your rest of the money back. Hopefully there will be more money back. So the delinquencies are very important. We need to always keep an eye on this number 6. So what I can tell you is that in Australia, and I have sat in a lot of risk committees across all the banks that I've worked for and in industry committees, there is not much to talk about when it comes to residential mortgage write-offs and delinquencies. There's not much to talk about. So in Australia, I can tell you people pay their mortgage. One way or another, they pay their mortgage. They may not pay their credit card, they may not pay their personal loan, but when it comes to paying their mortgage, they will get a second job, they will save the money, they will somehow make sure the roof on their head is there. So this figure is always a very, very small figure in banks. Is it going to go up? It might tick up a little bit, okay, but not the type of increase that the media talks about. The media has the least knowledge on these things, I can tell you. So yes, you're going to see mortgagee in possession sales. Absolutely. There's some people who have overstretched themselves. There's some people who've gone and bought 10 blocks of land and thinking that all of them are going to go up by 50 or 100,000 and they'll make significant amount of money, and they've only paid 5% for each block of land, and they're not going to settle for another year or two. Now, those people are going to have to dig deep, and they will probably have to forego some of those, okay? So you are going to see some stress situations, but they will be very, very few and far between. When an economist or the media tell you that property values are going to drop by 25%, this is the figure that will cause that. One is the fact that the bank has taken your property and they're going to auction it. That's number one. Number two is that when they do auction it, there's no buyers. Well, I can tell you that we are looking at distressed properties at the moment. particularly land values that have gone down about 10% across Sydney. And I can tell you that there are a significant number of buyers who are looking for a bargain, who are cashed up and looking for a bargain. So even if we have a little bit of delinquency, there will always be plenty of buyers there. The demand is still there. People are just pausing at the moment until the interest rate tightening cycle is over. That's very important to understand, okay? The economy is very important. We've seen the unemployment number at 3.5%. It is almost historic lows, the lowest it's been in 40 years. The GDP number, we're in a good place with GDP, okay? 0.8, 0.9% growth in a quarter is really, really healthy. Anything above a 3% GDP growth for an OECD country is very, very good. So we don't have a problem with either of these two things. When these two things are healthy, you find that you are not going to have delinquencies and write-offs, okay? So when people say 25% property price correction, they need to understand that you're going to have no growth, a recession, and unemployment has to be somewhere north of about 6.5%, 7%. It is not going to get there, okay? So that is very important for everyone to understand today. We know also that the government post-COVID is spending a lot of money on infrastructure incentives. We were even doing that in New South Wales before COVID, but across Australia, in every city, there is a lot of spending happening that is keeping unemployment really low. We have got a shortage of, we've got more jobs than people in Australia at the moment. That's why we need to increase our migration. And then the global factors we know. We've again, this has been there for a long time. The war has only just started to show how the global factors can affect inflation, and then the inflation in turn affects interest rates. The interest rates in effect hurts our hip pocket. Everybody feels it, okay? The prices that we pay for oil at the moment, we fill up our petrol, all of those things we're feeling it. So these things have a knock-on impact, but not as much, okay? Not as much. That's why it's number 7. Foreign exchange is another one there. As Australian dollar goes down, your Chinese buyers of property, your Indian buyers of property, your other buyers, foreign buyers that bring money here, they find that more money comes into the country and it's more affordable. That can have a upswing on our property market as well, but not as much. The number 1 is supply and demand, and the number 2 is interest rates and affordability. The other very quick point I'll make on this slide is banks, the big 4 banks in Australia all have a balance sheet of about, they're all approaching between 700 billion to a trillion, okay? Now, they're big balance sheets, they're all big banks. And they all make healthy profits. They all make profits of between $7 billion and $10 billion. So the banking system works very well. Half of their assets, 50% of a bank's asset, is actually residential mortgages. So go and pick up a balance sheet of a bank and online and have a look. 50% of the assets of a bank is residential mortgages. House lending to owner-occupied house and investment housing is their bread and butter, okay? That's why there is so much talk about the housing market and banks in Australia. Nowhere else in the world would you have anywhere near 50% of a bank's balance sheet in residential mortgages. We are an outlier in the world in that space, okay? So it's very, very important asset class for banks. Just want to make that point. Why did interest rates go up? I'm not going to dwell on this, except I want to show you this graph here, which goes back to 1990 and all the way until now almost. So we've had tightening of interest rates. This is the RBA cash rate. We've had a tightening here. We've had a small tightening here. We've had a long tightening here, and we've had a tightening here. So we've had 1, 2, 3, and now we're getting the 4th tightening. Yeah. Bookmark that, because we will show you what those tightenings actually did to property prices. The other point I'll quickly make on this slide is that the average cash rate from 1990 to now, the average cash rate is this graph here, okay? 5%. 5%. We are at 2.85% right now. and everybody is freaking out. The reason people are freaking out is because we actually went down to 0.1. I call it a honeymoon period we had for 2 years. Okay, we really had a honeymoon period for 2 years. So this is important that we all understand. When I say to my listeners, we are in a very low interest rate environment, we still are. We're still at 2.85. Okay. Yes, we've had steep increases. Yes, those of you who did not borrow money in the past or have only borrowed recently, you will feel that pain. When I first borrowed, and I've been here for 41 years, I can tell you that I paid this. I paid 17% for my first mortgage. 17. Okay. So I've paid all these rates throughout this period. And I can tell you that we are still in a very low interest rate environment. Okay. Now, this one, where to from here? Well, I thought we would stop. To be honest, I got this prediction wrong. I thought we would stop at 2.85. But the RBA governor has already opened his mouth and said we're going to go higher. So the next one will be 3.1, potentially 3.35, potentially. I think only one more to go, to be honest. And you're going to start seeing the evidence of the economy slowing down, the evidence of retail sales coming down, the evidence of inflation reversing. They are the things you need for interest rates to stop going up further. Please stop spending more than you have to, okay? Unless we stop spending, retail sales are not going to go down. And inflationary pressures are not going to stop. So that's very important for us. So listen, this one is very important as well. That's why it's been highlighted. Like I said, China has a zero tolerance policy on COVID. They've just changed that last week. Two things happened last week. US inflation became 7.7, and China said, we're going to turn a blind eye to COVID. So because they cannot go into a recession, the economy, the factories are shutting down. So they need to really boost the economy up again. Those two factors caused the Dow Jones, which is the equity index, main equity index the world watches every day. Dow Jones went up like nearly 1,200 points in one day. Okay. So things can move really, really quickly. Okay. So that's important. Why do I have this graph on the right side here? This is the implied futures cash rate. So there's a real cash rate, which the Reserve Bank sets. And this is what the fixed rates are set on. Variable rates are set on the cash rate. So it's 2.85. So the banks will say, okay, I'm going to add 2% to that roughly. So it becomes 4.85. Whereas the fixed rates are set by this graph. Okay. It's based on the futures market. And it is, once you get past to a certain level, then like if you're doing a 5-year fixed rate or 4-year fixed rate, past the futures market, then there is what's called the swaps market, interest rate swaps market, which is set on the bonds. Not time today to discuss that. It's a topic for another day. But all I'm trying to show is what the global markets think will happen to interest rates. They still think by September 23, we're going to be at 3.76. And then they think it'll plateau and then it start coming down around sort of early 2024. Okay. Are they always right? Mostly they are not right. Okay. This is their prediction. So this is where the futures market trades. This is their prediction. But I don't think we're going to get anywhere near that. I think we will probably stop somewhere around here. Okay. So remember I said there were those periods of increases in interest rates. This is the going from back to December 94 to August to December 94. We had a 2.75% increase. In the first year after the rate hike, we had a small jump in property price. In the 2 years after the rate hike, we had 2% jump. In 5 years after that rate hike, we had 26% jump. Then you look at 99 to 2000, we had a 1.5% increase. And you can read those numbers. They were very big numbers in that time, actually. The property price never fell. It went up. 3% increase over a long period, 2002 to March 2008. First year, property prices were down that much. and then it increased that much, and then it increased that much. So not something to write home about. It's been probably a very dull period after that. Okay, and then the more recent one, which since then there has been interest rates since 2010 has only come down until now, 1.75 and -4 and so on and so forth. Okay, so my point here is, listen, 1 year after the last rate hike, okay, this is 1 year after the last rate hike. So if, let's say, the rate hike finishes in February next year, example, so 1 year after that, what will happen to property prices? That's what this is showing you, this part here. And I can assure you the demand for property has not subsided. Demand for property is still going to increase with the number of people that are coming here, with the number of investors that are coming here, with the number of foreign people that are buying here through FIRB approvals. All of these things are still increasing. Okay, so my prediction is that a year after our last rate hike, okay, be it February, let's say it's February 2023, you will probably see the property prices actually go up after the first year, not actually come down. We've already had a correction. The correction would have happened even without the property, without the interest rate increases, in my personal view. This is what the 4 banks were predicting. This is about 2 months old, 2-3 months old, actually. So they were predicting the rates to be here. We're already here. So ANZ is there, and Westpac is at the same place. I'm probably thinking that it could be one more, and we'll get to that sort of 3.1 area. Okay, so we're nearly done. I think we're nearly done. Okay, with interest rates. So now more centric to Adelaide, which is the main area we're going to discuss today. I'll go through these slides pretty quickly. So you already saw that Adelaide was an outlier when it came to the last 12 months. Prices actually went up 15.4%. The median house price in Adelaide is still very low. Okay, still very low. And it's the 3rd lowest out of all the cities in Australia after Perth and Darwin. So it's still very, very affordable. So if I gave you a choice and I said, out of the bottom 3 in terms of median price, you've got Adelaide, you've got Darwin, you've got Perth. Where would you like to invest? And today I'm going to tell you why Adelaide, in my view, and in our view, is the right place to invest right now. Gross rentals are still very healthy. Rental prices are rising. And the last number here is very important. Vacancy rate in Adelaide at the moment is 0.2. And we'll see another graph on that in a minute. This is the lowest, by the way, in Australia. So what's great about Adelaide? Why is it a great city? First and foremost, Adelaide has recently been named the 3rd most livable city in the world after Auckland and Osaka. Okay, it's got to be good reasons why that is. So it's continued to excel in stability, healthcare, education, culture, environment, innovation, infrastructure. And I'm going to show you a few slides today on each of these, okay? So as a result, we've seen the highest levels of interstate migration to Adelaide for the past 30 years. The numbers are not huge, but it is significant from a city's point of view to see the highest level of interstate migration in a 30-year period. So that's important. Infrastructure. So the first thing here is infrastructure, okay? They have got significant infrastructure in each of these things. So education, number 1. It's home to some of Australia's highest ranked universities. Some of you may not know that Adelaide is now got the reputation as a university city, comparable to that of Boston in the US. So a lot of students go and study in Adelaide, okay? I don't know whether it is cheaper or the climate is better or the place is just nice and relaxed, but that is a fact. Health, they've become the epicenter for health community and ever expanding health precinct in the heart of the CBD. There's a lot more research happening there. There's world-leading research, global implications. all of these things, I mean, I'll let you read that faster than I can say it, I suppose. So, and then defense, you all heard of the defense, and we've got a separate slide on that. There's billions of dollars being spent in Adelaide on defense. And the city is got it's a good environment to stay in because it has got the beaches. It's got a lot of outdoor activity. You all heard of Barossa Valley. There's a lot going for the city. Infrastructure as well. They have, like I said, the government is spending a significant amount on infrastructure. So they redeveloped the riverbank precinct, which is this slide down here. And the central market development is going on as well, which is a big development for them. And then they're connecting the city a lot better to the north and the south. Okay, so there is a 78-kilometer north to south connect motorway. And you see that over here, all the way from the area we are talking about, the north part of Adelaide, where there is still land that they are selling. And that is the growth area. It's the same way in Sydney, you've got the northwest and the southwest. That's where all the land is. Adelaide, most of the land is in this north area. Okay, and that's where people are investing, and that's where property is still very cheap, and that's where property is going to increase in value. Now, innovation. They've been known for innovation as well. So you've got some very big companies like Google, Amazon, MIT, Deloitte, PwC, IT services, multinationals like Accenture. They're all setting up shop there. Okay. So I'd like you to Google these actually. So lot 14, I'd like you to Google lot 14 and see what they have created in terms of a precinct for innovation, research, education. Some of these buildings actually you see are part of that. Okay. And also Tonsley Innovation District is massive as well. They've got a lot of leading edge research and education institutions and startups, and that's this picture here. So there is the government there is enticing a lot more research companies and IT companies to set up shop there and create innovation. I did say I had a slide on the defense, and most of you already know about the big submarine project and the naval base that they have. There is also the Adelaide Airport expansion, which is going on. These are all big projects. Okay, there is a big military setup there as well. So all of these things are just to highlight what is happening in that economy there, what's boosting the economy there. But the biggest thing that nobody talks about in South Australia is the mining side. When you talk mining in Australia, people immediately think of Western Australia. Nobody actually says to you, well, what about South Australia? Well, there are mines all over Australia. We all know that, for different type of products. Queensland is big in mining and Western Australia is big in mining. But South Australia equally is very big in mining. And I just want to highlight to you some of the big projects that they have, okay, on the left here. So this is all very close to Adelaide as well, okay? So it's this area here where you've got all of these big mines. So we will talk a little bit about Olympic Dam. And then we've got like the other ones here, Whyalla, Woomera. These are some very big dollars here you can see on the right with some of these mines. If my listeners today haven't heard of Olympic Dam, it is one of the most important mines in Australia. This is the reason why. Everybody knows about uranium. So these are the top 20 uranium deposits by remaining resources in the world, okay, in the world. So the first one here is Olympic Dam. Look at number 2, okay, MacArthur River, and then it goes all the way down here. There is no bigger deposit of uranium in the world than the Olympic Dam. And guess where it is? It is in Adelaide. Okay, it's in South Australia, I should say. Once this whole project is completed, it'll be the world's largest open cut mine. It is currently the world's largest source of uranium. It's got biggest gold resource in Australia. So it's not just uranium. Okay, 5th biggest gold resource in the world, 4th biggest copper resource in the world. It has a commercial life of 200 years. Very, very important to note. So it's got a lot of, when you invest in property, you need to make sure that that economy is going to be strong, it's going to be robust for many, many years to come. And you've got to base all of that on strong evidence. And that is good evidence. But I've got more evidence here in terms of what is happening there. So 1.9 billion Women's and Children's Hospital. You've got $1.25 billion development by Gurner and Kennards, which was announced earlier this year. You've got a skyscraper here, which has been approved just on 15th of September. Okay, 180-meter tower in the heart of Adelaide. And then the Barossa is going to have a 6-star hotel, the only 6-star hotel in all of Australia. So Barossa is already a destination where people go for wines and so on. This is just going to add another attraction for people to want to go there. I'll skip this one. This one is really showing you that back in June, they had a sale of this house, which was $1 million almost over reserve. So when that happens in a market, basically you'll find that that sort of filters through to the rest of the market as well. So Adelaide property market, some very quick points on why we think the Adelaide property market is a great buying opportunity. I still call it historically low interest rates and a high appetite for banks to lend. Demand will continue to be strong. More and more people are going to continue to go to Adelaide. Land is running out. So there's only so far you can go up north. Supply, therefore, will be significantly down. Okay, I'll let you read those bullet points. And then cost of construction, we all know, is gone up. And it may go higher. So if you can lock in a house and land price today, you know that your value of property is going to go up. Rentals, like I said, they've got chronic shortage of properties. People are now starting to look at where is it affordable, where can I get good capital growth. Those that have invested in Brisbane, we've had buyers who invested in Brisbane 2 years ago. They're coming back to us and they're saying, where should I buy now? I've got equity. And we are pushing them to Adelaide for the same reasons, exactly the same reasons why we pushed them to Brisbane in the first place, Southeast Queensland. Business confidence is high. That's why unemployment is so low. Everybody's hiring people, okay? And then last one you all know about. So nationally, where are we when it comes to vacancies? So we've gone from October 21, September 22, October 22. Sydney is now at 1%. Nationally, we're at 0.8. This figure keeps coming down. Every month it keeps coming down. Very soon it'll be 0.5. And all these capital cities, we're going to go to 0.5 by June next year. Okay, that's going to be chronic. Adelaide's at 0.2. At 0.2, basically there is no houses to rent. For every house that comes up for rent, there is probably about 50 people who want to rent that. And what does that do? Push up rental prices even more. So this is already at chronic levels and about to get worse. I've been talking about the rental market now for a very long time. North of Adelaide, where we've got our projects, this is what has happened. Okay, it's gone down, 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 down. We are now at 0.2 roughly. So very simple graph here. Are we seeing economic growth? Absolutely, our economy is growing and growing better than a lot of countries. We're going to see jobs growth. Okay, we've got more jobs than people. These two factors are going to push wages growth. Wages is not growing very quickly yet. You see that in the media all the time, but wages is going to grow because of these factors. And then population growth will keep wages growth in check. So when you've got shortages, wages growth is going to go up. When more population comes here, then it'll come back down again. So I think what you'll find is unemployment has to go up. Okay, has to go up to somewhere which is more healthy than 3.5. It's got to go up to about 4%. And you'll probably see that happen over the next 6 to 9 months. All of these causes increase rental and buyer demand. And that causes property prices to actually go up. So what this graph actually shows you very, very simply is that it is not all about interest rates. It has never been all about interest rates. And you've seen the last 4 tightening cycles and what happened to property prices. Do not have a short-term view. You've got to see all of these factors before you invest in property. And now is a very, very good time to be buying where we are telling you. So when you buy, what are the key considerations? You got to look for location. Number 1, location. Number 2, you got to make sure the price is right. Okay. Never pay a premium for a property. Never, ever pay a premium for a property. Very, very important. Okay. So you got to buy, and you got to buy the right type of property as well. So all these things are important for location, as you see. Timing is important. That's why I say to you, you should not be buying a house and land package or we sold a lot of dual keys in Southeast Queensland. Dual keys were the in thing, and even duplexes. Now dual keys and duplexes are sort of getting in the high 800s to $1 million. We're saying to people, do not even go there. That is not a good value for your money. Okay. And then the developer and builder becomes more and more important. You need to make sure that when you say fixed price, it's fixed price. You want to get a quality product, you've got to have a seasoned developer who can actually develop that for you. So in summary, why Adelaide? We've got very low vacancy rates. Views per listing is still increasing. Everybody's looking at Adelaide still. It's highly affordable with the 3rd lowest price after Darwin and Perth. And Adelaide to me is where Brisbane was about 12 to 18 months ago. Okay. So now without further ado and conscious of time, I'll pass on to my colleague Krish. And Krishan will talk about our project today.
Thank you, Sachin. Hey, everybody. It's Chris here from Nivas. Thank you for joining us this evening. Sachin has elaborated a lot on the economic side of things and on a high level what Adelaide has to offer. Now, I'm going to hone in a little bit more on a specific suburb that we're looking at in Adelaide. So Manapara, this is the area that we are quite heavily focused on. We have been selling in this area for some time. We have been watching land prices increase. We have been also watching. So what's been happening in places like Manapara is the local councils are basically saying, no, we don't want investors. We only want local people to be able to buy. So it's getting the market there is very, very tight, and there's significant amount of demand. Now I digress. Manapara, what you have here in front of you is 16 different schools. You've got different services, many different services in terms of shopping centres, train stations. You've got the Northern Motorway, which provides good connectivity as well to the CBD. So what I think of Manapara is very much like Marsden Park, right? So people who are familiar with Marsden Park, when you went there about 10 years ago, there was nothing. It was literally just dirt and a few houses here and there. Now you go there, it's a hustling, bustling, sort of thriving community. And that's very much what is happening in Manapara at the moment. So you've got all the infrastructure in place, and you've got our projects are also very close to these infrastructure projects as well. So close to train stations, shops, schools, and everything. So if we pop across to the next slide. Now, this just shows you where Manapara is located. So Adelaide CBD, you go up and it's north. So basically about 40 Ks north from the CBD. And the beauty of this place, guys, is that not only are you, within an okay proximity to the CBD, but you're only about half an hour from the Barossa Valley as well. So you're in that nice sweet spot in the middle ground there, which is a lovely place to be. Yeah. Then if we pop across, so guys, we have a few house and land packages that I did want to share with you today. Now, these packages, again, I'm just going to skim through it. I'd rather do this on a one-on-one basis with you to go through it in more detail. But the builder that we have is very good value. They are turnkey packages. So there's nothing left for you to do. So your driveway, fencing, everything is already done. A high level of inclusions as well. Good size homes. We like to pride ourselves on the fact that our per square meter rate is amongst the lowest in Adelaide. We are the best we have the best value builder in the suburb, or in the city, I should say. So you've got fantastic finishes, very well priced, as you can see. So 533,000 for a 4-bed, 2-bath, 2-car home, and you'd be looking at about 490 to 500 a week in rent. This is for a 21 square home on a 360 square meter block. Now, guys, I need to stress this, right? In Sydney and Melbourne, the last 6 months, all we've been hearing in the media, oh, it's going down, market's going down, 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 down. While the market has been supposedly going down all across Australia, that's not the case. In places like Adelaide, if you go back and see the auction clearance rates the last 5 weeks, they've all been above or between about 75 to 80%. So that's still a hot market. So you can imagine when a market like Adelaide is still performing strongly, when supposedly the market across the rest of Australia is performing poorly, then can you imagine what it's going to be like when, as Sachin mentioned, interest rates do pause and the market does come back, and the buyers start entering in full force again. So while these prices are quite attractive now, guys, they are increasing already and will start to increase even more next year. So if we pop across to the next slide. Now, basically, this, guys, is where your entry level sort of house and land is, right? So at 453,749, you're getting a 4-bedroom, 2-bath, 1-car home. So this is about a 18 or 17 square home, which is, look, it's a decent size home. Rental for this, erring on the side of caution, is about 460. So that's being conservative, right? By the time this place finishes, I have no reason to believe why it wouldn't be at about 480 to 490. That's how fast rents are increasing in Adelaide at the moment. It's just insane. Like, you go and have a look at Manapara, how many houses are for rent. I think there's barely a couple. There's not many homes there. And as soon as they come up, they're gone. That's how crazy it is there at the moment. So very, very good, attractive entry prices. Land prices, for a 300 square meter block of land, you're getting it for 154,000. So again, significantly good value, and an investor's dream. Low vacancy rates, a low entry point, and high rental yields. So it works out quite well. Now, this is another option we have. Now, this is in another suburb called Devon Park. Again, close to all the infrastructure and amenities, which I can go through with you on a one-on-one basis. This evergreen estate is one of the nicest estates that they have in Adelaide. So it's a new master plan community, obviously schools and shops and everything nearby. So a very, very good suburb as well. Again, vacancy rates here are sitting at about 0.2%. So in the suburb, so it's insanely low again. Now, this is a bigger land, so 408 square meter block of land for 190,000. It's roughly a 20 square home. Again, you can read through all those finishes there. So that's another option. If we pop across to the next slide. Now, look, for the most part, the terms to purchase a house and land are very, very, sorry guys, bear with me for a second. The terms to purchase a house and land are very easy compared to Sydney and Melbourne, right? So, for example, just to take the property off the market, it'll be $1,000 deposit, right? We are exchanging on blocks of land there anywhere from $10,000 up to 5%. So if you find a block of land that registers in 6 months' time, in some of the estates we have, you just need to pay 10 grand to secure it now, and then nothing else until completion, right? So the terms are very favorable. The build time takes roughly about 6 to 7 months. And again, that's being conservative. It usually is a bit quicker than that. And in terms of a house deposit, guys, it's 2%. So it's not like Sydney where you're paying 5 or 10%. It's a 2% deposit in a house contract. And these are the terms that we have got agreed to by the builder. And that's because we have this relationship with the builder. So, guys, low price point, the market there is still performing strongly, irrespective of what's considered a cool market at the moment. Low vacancies, you got high rents. It's an investor's dream. Honestly, it really is. And land prices there are moving every 3 to 4 weeks. They're going up, right? So as I mentioned, you can imagine what's going to happen in a hot market. So I will leave it at that. What I'd love to do is book in a one-on-one with anybody who's interested. I can go through all of the, all of the details with you and take you through it on a more in-depth level. Now, one other thing I wanted to bring up here, which is a very important thing, is the build cost, right? So in Adelaide, one thing I will mention is that agents there are notorious for putting on properties which are significantly lower than what the actual market price is. They just try and get people to sort of inquire on the ad and build their database. But I encourage you to compare what we have versus what they have. And once you actually look at what all of the actual inclusions are, you'll find that the value of ours is significantly better, or our builder. So the things to look out for are, ceiling heights, concrete paths and driveways, our blinds included, landscaping, those sort of things. So again, if you are serious about buying, you do want to have a chat with us. We'll sit down with you. You can bring any other, comparables that you like, and we'll go through it. We'll pick it apart and we'll make sure you are getting the best value. That's where we go above and beyond. So if we pop across to the next slide. Okay. Now, I'll leave that with Sachin. Thank you, guys.
Thank you. So a few concluding comments. I hope I've given you some insights today that you should not follow the media blindly. Our due diligence and our recommendations are always well researched. We have an ethic in our company and value in our company that we say we will never show a project where we will not buy ourselves. So where we don't see value, we walk away from it. So we have been concentrating on Adelaide house and land, as I said, now for a good 5 to 6 months, and we still see significant value there. It is still rising. It's about halfway through its upward trend. So yes, if you bought about 6 months ago, you will already be sitting on about 30 or 40,000 in equity. But now is the time, if you are looking at making significant equity over the next 2 years, this is the time to do it. There's a very low entry point, as Christian said, to get in. You only need about $15,000 to lock something away that might start in 6 months' time. So it's not a lot of money. The terms that the builder has agreed is very reasonable. When you're buying properties, you got to have a long-term view. So yes, interest rates have been rising over the last 6 months, but it's going to stop rising soon. Okay, you don't buy properties like stock market and you sell the shares after 6 months or 3 months or one day. Property market, you've got to look at the long-term view and you've got to build a portfolio. What we concentrate on with our clients is how you build that portfolio. I always say to my listeners, particularly when you are professionals, husband and wife might be working and both might be professionals, there is no reason in this world why by the time you retire, you cannot have double-digit property portfolio, okay? You need to keep buying at that entry price and enjoy capital growth, enjoy good returns, and let the bank pay for your property. You should not be paying too much for your property out of your own pocket, and start building a portfolio. So when I say double digits, I mean that. I think everyone listening to me now, if you've got a good job, paying a good salary, there is no reason in the world why you can't retire with at least 10 to 15 properties. Okay, that's what you should be targeting. If you don't think it's possible, then you need to have a chat to me. And I do offer that one-on-one discussion and show you how it's done, because I have done it myself. And there's no reason why any of you cannot do that. The reason why you need to keep investing in property is because property makes you money. In the long run, property makes you money. None of us can retire on our super, okay? If you have $1 million in the bank and your house is paid off, let's take the scenario where somebody does not buy a property. If you have $1 million in the bank and your house is paid off, you cannot retire on it. Why can't you retire on it? Because $1 million in the bank will pay you what today? 2.5%, 3% interest. Let's say 3%. 3% on $1 million is $30,000 a year. Can any of you live on $30,000 a year? Absolutely not. So you need to always invest in property, but you need to make sure you buy at the right price, buy at the right place, buy the right property. Okay. I will leave it at that, and we will take some questions.
Yep. No such thing as a silly question, guys. So feel free to chime in. Yeah.
there any questions in the chat?
Not
No.
at this point. No, I've put our details in the chat as well, guys. So our phone numbers are there. Just send us a text message. We'll book you in for a one-on-one, and we can go through everything in more detail as well. Any questions regarding the economy, where to moving forward for the economy, Adelaide, Sydney, Brisbane, Melbourne, Perth?
Yep. Happy to take any questions. Thanks.
One quick question.
Sure, Subhash.
Adelaide has seen good growth in terms of prices. On the other hand, Sydney has gone down. I mean, Sydney, I can feel that it's a bit volatile market. The upward growth is higher as well as the lower side downslide as well. So if money is not a problem in the sense that down payment, would it be better to invest in Sydney compared to Adelaide? Because it has slided more down, so there is more growth potential here.
Yeah, Subhash, thanks for your question, and it's a really good question. So listen, in Australia they say horses for courses, right? So you run a different horse when the track is wet and soggy, and a very different horse when it's dry and fast. So the thing is that absolutely you are right that Sydney has good opportunities for you to strike a bargain, certainly at the moment until the tightening cycle is over, and that period is going to be quite short-lived. Okay, so if people think that next whole 12 months is going to be a good time to buy properties in Sydney because the market will be very depressed, they are very, very wrong. So what will happen, you'll find, is that as soon as the tightening cycle, so a lot of people are pausing at the moment because they want to buy what they call at the bottom of the market. So yes, there is a correction going on, and yes, we've had a very strong 2021, but that bottom of the market is going to be between now and March next year. Okay, as soon as the market thinks, sorry, as soon as the market has the perception that tightening is over, all that cash that's sitting there and people who have been on the sidelines for the last 5-6 months, they'll all enter the market.
Yeah.
So if you want to take the advantage of the Sydney market over the next 3 months, please do that over the next 3 months and don't wait until June, July next year. So your point is absolutely right that there are good opportunities to buy in Sydney at the moment. You will need significantly more money, obviously, to buy in Sydney than over there. Okay, for 435,000, our cheapest house in North Adelaide, you will be lucky to get a 1-bedroom apartment.
Yeah, I agree.
Okay, now this is a low-level entry point. So yes, if you are building a portfolio and you want a good investment with a good return, and there is still a lot of room for the market to go up, then we are saying our first pick at the moment in that sort of price range for any property in Australia, we are saying is these houses in North Adelaide. Yeah. Yep. So your point is very valid. And it is not a apples with apple comparison. If somebody bought in Sydney today, land values have gone up a good 10%, gone down a good 10%. You know, in a number of suburbs in Sydney, whether it is Austral or Box Hill or Marsden Park, all of those places. So yes, you can go and buy a land now. Will that land go up more than the price of those houses in Adelaide? Time will tell. But you're getting something at a low entry level to build a portfolio, good time, good place. It ticks all the boxes for me. And that's why we are recommending it.
Yep, got it. Thank you.
Great. Thanks for the question.
Sachin, I have a question.
Sure.
So is it still worth going for a dual key house, considering that the build cost is costing around 150,000 more than a normal single key house? Let's assume the land was bought last year and the land has appreciated. So if given two choices, buy a single key house for 400,000, which is roughly around the range which is going on now, or a $550,000 for a dual key house, what would you recommend? And I'm talking in NSW, not Adelaide or Sydney.
You're talking about
NSW in general.
Sydney or which?
Hunter Valley, Hunter region.
You're talking about Hunter Valley. Okay, so
Yeah.
you bought a land in Hunter Valley and the price has appreciated at a decent gain, and
Yes.
you bought the property to make a dual key house. Is that right?
Well, I did not intend to build a dual key house when I bought it, but now I'm getting two options, either a dual key or a single key. But the difference in the cost is 150,000.
Listen, it's a very specific question relating to your property, and I guess you're looking at options of what you should build there, maybe versus what else you can do with that money. I'm happy to take this one offline, AJ, and we can, you can call me and we can have a chat about it.
Okay.
And look at the pros and cons for you. Yeah. The main thing with property is to take decisions that make you the biggest bang for your buck, right? So we can discuss the pros and cons of what your options are. Yeah.
All right. No worries.
I'll
that
just
okay?
chime in there for 1 second. Sorry to interrupt, guys. Am I just a guess? Is this in Queensland by any chance, or
No,
is it?
Hunter Valley.
No.
Oh, Hunter.
it's in-
Sorry. I
Hunter
missed
Valley.
that.
You
Okay.
missed that. Yeah.
Hunter. All right. Cool. No,
Yeah.
what I was going to say is that with dual key properties, what I found, right, in Brisbane, especially in the last sort of 12 months, is that because there's such a discrepancy in price between a standalone home versus a dual key in terms of that 150,000 gap, when a bank comes to value the dual keys, the dual key valuations sometimes tend to be under, right, because they look at it as a single title.
Right.
So that's just one thing to keep into consideration, because not ones that I've sold, but I've had people come up to me and say, oh, my vals have come in 80, 90 grand under because my valuations have come in 80, 90,000 under because the bank just doesn't look at it as two dwellings. So just one thing to keep in mind. So
Yeah.
Yeah.
I mean, if you have the cash to do it and you got the loans to do it, then not an issue.
100%.
But AJ, we'll take that offline if that's okay. Feel free to call me and we'll make a time to chat.
Yeah. Thanks, Sachin. Thank you.
You're welcome. You're welcome.
Okay. Any other questions?
I don't have any questions, but I just wanted to thank you guys for the insights. So I am a
thank you.
potential first-time buyer, and this is definitely going to help me understand the market, and also to probably make a decision in the near future. So thanks a lot for appreciating.
Sure, Gaurav. Anytime, and if you wanted to chat with us, we don't charge. We like to help people accumulate property portfolios and buy in the right places at the right prices. So feel free to reach out to us and have a chat. Yeah.
Absolutely. Yes. Thank you very much, sir.
You're welcome.
Thank you, Gaurav.
Okay. And is there one or two last questions? No, everybody's happy.
No, all good.
Well, you've got our numbers there, and as I said, you feel free to give us a shout.
Anytime. But thank you all for attending, and call us or message us if you need anything at all.
Thanks a lot.
Thank you, guys.
Thank you.
Have a good night.
Thank you very much. Bye.
Take care. Bye.